At the peak of his power, the CEO of a 158-year-old investment bank earned more in a single year than thousands of families would earn in a lifetime. His firm advised governments, shaped global markets, and carried a balance sheet larger than the economies of many countries. Then, in a single weekend, it collapsed into bankruptcy. Phones stopped ringing, credit froze. Employees carried boxes out of marble lobbies, and the world learned a brutal truth. The global financial system, worth tens of trillions of dollars, was balanced on assumptions that were never as solid as they looked. The 2008 financial meltdown wasn't triggered by a single bad decision or a greedy banker. It was the result of a system that quietly rewired risk, rewarded denial, and collapsed the moment reality caught up. To understand what really happened in 2008, you have to go back to a time when finance still believed it had tamed danger. The decades leading up to the crisis were marked by confidence bordering on arrogance. Inflation had been controlled, recessions were shorter and milder. New financial tools promised to spread risk so widely that no single failure could bring the system down. Economists spoke openly about the Great Moderation, the idea that modern finance had learned from history and engineered stability itself. At the center of this confidence was credit. After the dot-com crash in the early 2000s and the shock of 9/11, central banks slashed interest rates to stimulate growth. Money became cheap. Borrowing surged. Homeownership was promoted not just as a personal milestone, but as a national policy goal. Banks were encouraged, sometimes pressured, to lend more, especially to borrowers previously shut out of the housing market. The logic seemed sound. Rising home prices would protect lenders, expand wealth, and stabilize communities. But something subtle was changing beneath the surface. Traditionally, banks that issued mortgages kept them on their books. If a borrower defaulted, the bank took the loss. This created caution. In the 1990s and early 2000s, that model shifted. Mortgages were bundled together, sliced into pieces, and sold to investors as mortgage-backed securities. The risk was no longer concentrated, it was dispersed. Or so it appeared. This process, called securitization, was supposed to make the system safer. In reality, it made it more fragile. Because once banks stopped holding the loans, they stopped caring as much about their quality. The incentive was no longer to ensure repayment, it was to generate volume. The more loans written, the more fees collected, standards slipped. No-doc loans required no proof of income. Adjustable rate mortgages offered low teaser rates that exploded later. Borrowers were approved who clearly could not afford the payments long term, but that didn't matter as long as housing prices kept rising. And for a while, they did. As demand surged, prices climbed year after year. Homeowners refinanced repeatedly, pulling cash out as values increased. Construction boomed. Wall Street took notice. Investment banks didn't just sell mortgage securities, they engineered increasingly complex products based on them. Collateralized debt obligations, or CDOs, repackaged slices of mortgages into new instruments. The riskiest loans were mixed with safer ones, and through mathematical models, magically transformed into securities rated AA, a highest possible rating. That rating was the key. Pension funds, insurance companies, and global investors were desperate for yield in a low-interest world. AAA-rated products seemed safe. They poured money into demand, fueled more lending, which fueled more construction, which fueled higher prices, which validated the models. The system fed itself, but the foundation was weaker than anyone wanted to admit. The models assumed that housing prices would never fall nationwide. They assumed defaults would be isolated, not correlated. They assumed liquidity would always exist, that assets could always be sold. These assumptions weren't tested against reality, they were tested against history selectively interpreted. Then came the first cracks. By 2006, housing prices stopped rising. In some regions, they flattened. In others, they dipped. For borrowers with adjustable rate mortgages, payments reset higher. Defaults ticked up. Initially, Wall Street dismissed it as a contained subprime issue. Losses would be manageable. The system was diversified. But diversification doesn't work when everything depends on the same underlying assumption. As defaults rose, the value of mortgage securities became harder to determine. These assets didn't trade frequently. Their prices were based on models, not markets. When uncertainty grew, buyers disappeared. Banks that held these securities suddenly couldn't value their own balance sheets. Trust evaporated. The real danger wasn't the losses themselves. It was the uncertainty about where the losses were hiding. Investment banks had leveraged themselves heavily, borrowing enormous sums to amplify returns. In March 2008, Bear Stearns collapsed and was sold in a fire sale. It should have been a warning. Instead, it became a precedent. Markets assumed the government would step in to save major institutions. That assumption calmed panic temporarily, but it also encouraged delay. Throughout the summer, cracks spread. Mortgage giants Fannie Mae and Freddie Mac required government intervention. Losses mounted quietly. And then, in September, the unthinkable happened. Lehman Brothers was allowed to fail. The decision shocked the world. Lehman wasn't just another bank, it was deeply embedded in global finance. Its collapse triggered a chain reaction. Money market funds broke the buck, interbank lending froze, companies couldn't roll over short-term debt, payrolls were threatened, global trade slowed because letters of credit vanished. What had started as a housing downturn became a full-scale financial meltdown. Within days, AIG, a massive insurance firm, was on the brink of collapse due to its exposure to credit default swaps tied to mortgage securities. Had it failed, losses would have cascaded through every major bank. The government stepped in with an unprecedented bailout. Trillions of dollars were committed across multiple programs to stabilize the system. The fallout was immediate and devastating. Stock markets crashed, retirement accounts evaporated, millions lost their jobs, millions more lost their homes. Small businesses failed not because they were unprofitable, but because credit disappeared. The real economy workers, families, communities paid the price for risks taken far above them. And yet, the story didn't end there. In the aftermath, governments scrambled to assign blame. Bankers were vilified, regulators were questioned, rating agencies were exposed as conflicted and flawed, new regulations were passed, capital requirements increased, stress tests were introduced. The system was patched, but many of the underlying incentives remained. Banks became larger. Risk shifted into shadow banking. Complexity increased. The belief that certain institutions are too big to fail hardened into expectation. And once again, markets began assuming that in a crisis, intervention would come. Modern parallels are impossible to ignore. Today, global debt levels are far higher than they were in 2008. Financial markets are more interconnected. Derivatives remain opaque. New asset bubbles form under different names: tech, real estate, private credit. Central banks have expanded their balance sheets to historic levels. Interest rates stayed artificially low for years, encouraging leverage across the system. The pattern repeats because the psychology repeats. Periods of stability breed complacency. Complacency breeds leverage. Leverage amplifies shocks. And when the system breaks, the response shifts losses from institutions to society at large. The most uncomfortable truth about 2008 is not that mistakes were made, but that many people knew the risks and chose not to act. Warnings existed. Internal memos flagged problems. Analysts raised concerns, but incentives rewarded short-term profit, not long-term resilience. The system didn't fail because of ignorance. It failed because acknowledging the truth was inconvenient. And that's the part that matters most today. 3 takeaways stand out. First, financial crises are not accidents. They are the predictable result of systems that reward risk while disguising it. Complexity doesn't eliminate danger, it hides it. Second, when finance detaches from the real economy, the damage eventually flows downward. Losses don't vanish. They are transferred from balance sheets to households, from institutions to taxpayers. Third, stability is not permanent. Every system that claims it has eliminated risk is usually the one most vulnerable to collapse. History punishes certainty more than fear. The real question isn't whether another crisis will happen. It's whether it will look familiar or arrive in a form no one expects. If this breakdown helped clarify what really happened in 2008 and why it still matters, consider subscribing for more deep dives into the forces shaping our world. Because the next meltdown, like the last one, will not announce itself. It will build quietly while confidence remains high.